The Wall Street Journal ran a column by Jason Zweig that every retiree should read twice. It's getting harder to tell investing from gambling, and it's not your fault. Zero-day options now make up over half of all S&P 500 options volume. Leveraged ETFs hold $240 billion. Prediction markets pulled in nearly $64 billion last year. Today, what that means for your retirement.
Welcome to Label on Fire with Amazon best-selling author and Yields for You portfolio manager, Label Sternbach. Label on Fire is supported by our ETFs, Yields for You Strategy A, and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Label on Fire.
That Wall Street Journal article has really got my attention. He says between the lines that between investing and gambling, he says those lines have been blurred. I'm wondering what changed and why should a retiree care about that?
Yeah, it is, we're talking about this on the show quite a bit over the last probably 18 months, 2 years, that there's been this shift, right, really ever since COVID, where the old rules of how the market worked, the cold, rational, right, and textbook, and the economists say something's going to happen, that's what the market kind of follows. That kind of all got thrown out the window. And it hasn't been, kind of like an all at once type of thing. It happened a little bit slowly. But we saw it with COVID, right? COVID was supposed to be this whole, we should have had another kind of 2008 type of moment. Market went down 35% and then bounced back. And we had the strongest bull market, ever. And then you have the same thing, right? Last year, right? Trump gets into office, tariffs, right? Supposed to be the end of the world. All the institutional investors, all the smart money was like, okay, this is again going to be a massive recession, massive, market correction. We got to reevaluate everything. Market crashes almost 20%. And what the market goes, you smart pants, you're wrong, right? And it bounced back within, I think it was 3.5 months. And we've talked about it, right? Institutional money used to control 98% of the market, right? Which meant that, the smart people, the people with PhDs, the people who were paid a whole lot of money to figure out how the market should work, they controlled the market. So the market worked the way that they said it worked because they were the market. But now they're no longer the market, right? In COVID, I think the number was 65% was institutional, and it's only getting less. And it's only getting less. And then compounding this, you have these things like zero-day options, these are options that expire today, right? So day traders, their whole motto is, I buy something and I sell it by the end of the day. I close my position by the end of the day. Win or lose, right? I close the position. And that is how day traders are supposed to operate. Well, zero-day trade and zero-day options work in a similar fashion. And so and just to refresh everybody, right, what an option contract is just like when you buy a house, right? You go to contract on the house and it's okay, I put down, a small deposit, but now I control this property, right? I control $1 million property or $500,000 property with, $5,000 deposit, right? It's a very small amount that controls a very large amount. Options do something very similar, right? They allow you to control a huge amount of stock with a very small premium that you're paying for that option contract, which can, accelerate gains and accelerate losses, which when you look at that as the stock market, right, all of a sudden it's controlling billions, even trillions of dollars in capital by people who don't have billions and trillions of dollars in capital, and they're moving the market because they can, right? And so when you have people who are betting on a whim and moving the market on a whim, not based on rational fact, not based on hard math, not based on, statistics for the last 100 years or 200 years or 500 years or understanding of economics of how people will react to things, you end up with a market that behaves very similar to a casino.
Wow, a casino. So how do you tell whether or not you're gambling when you're involved in this right now? That's the topic of what we're talking about, investing versus gambling. So how do you tell position by position whether what you own is an investment or if you're at the casino table?
Well, I think it's the same answer that you have to ask of the person who's gambling. The difference between a gambler and somebody who is, it's their job to go to the casino and that's what they do, right? There are people who that's a livelihood, right? And they file on their taxes and they get to take their gambling losses off of their tax return. Because at them, it's truly a business, right? They're playing the statistics of, the house wins 51% of the time and you can have different strategies and you can win, right? You can make sure that you win more than the house. Statistically over time, the house will win more times than you. You just need to make sure that when you win more than what the house is winning, right?
Exactly.
And so the same kind of thought process that you take to any type of investment and what is my reason for going into this? What is my thought process? Is it backed up by fact? Is it backed up by what the sentiment of people today is, right? This is becoming more important than it was probably in the last 25 years. It used to be more important prior to that. But how do people feel about the market? How do people feel about the economy? How do people feel about politics, right? It used to be politics wasn't part of the market so much, but now it's very much a part of the markets. And you got to weigh that into your analysis now of investments, and you got to go in with proper expectations, and you need to know what your exit strategy is, right? Every investment that you're purchasing, you need to know what's going to make you exit that investment strategy, what's going to tell you that it has proven to be successful, what is going to tell you that it's been proven to not be successful, right? And that, in investment terms, we call this a regime change, right? When has the fundamentals of the fundamental assumptions that we're making about how the market operates, when does that change? And we now need to flip it. I'm gonna throw one out at you right there. There used to be one that was, and still today to a certain extent, there used to be one about stocks and bonds and you have one today that's similar. It's about treasuries, but there used to be one back in the 50s, right? And it was true for 100 years that when stocks went down, bonds went up. Why? Because people would take their money out of the thing that could lose capital and put it into the thing that had principal preservation as part of it, right? That you could go to bankruptcy court with a bond. You can't go to bankruptcy court with an equity. You're the last one in line, right? And so for the longest time, there was an easy trade of when, stocks went down by a certain percentage, you just switched to bonds because bonds were going to go up. You knew what was going to happen. And for the longest time, you had that equities and treasuries, right? You had this thing called a flight to safety. When market would get volatile, people would take their money out of the market and they would give it to the U.S. government and say, hold my money for me, right? Protect me from what's coming. And now that's not happening anymore, right? But it's happening. You have it in institutions that are still doing it. The retail investors are not doing it. And their retail investors have basically been firing the institutional investors for a very long time. And so now you have that kind of like that dynamic isn't as predictable as it used to be. You can't count on the same rules that have been for the last 25 years to hold up for the next 25 years. And you got to go in with your eyes open.
So how would I get my child or my grandchild who's a day trader? How do I talk to them about this whole concept without appearing to be that person standing at the podium lecturing?
Yeah, well, there's every generation, right? And, they think they know more than the previous generation. And actually, a really great article, I think by Jason as well. I think it was last weekend's edition, not this past one, the one before it. One of the last few weeks he wrote, and he said about this phenomenon, right? Of depending on what generation you were born into, right? When you started in the market could have had an entire percentage point difference. And so some people had just experienced negative years, right? In their formative years of the market. And some mainly had positive years. And so when you look at investors who their only experience in the market has been the last 10 years or the last 15 years, right? Post 2008, post, Great Recession. Well, all they've seen is the market go up, right? So you're going to tell them that the market has a possibility to go down. You're going to tell them that 2007, it didn't recover until 2012. You're going to tell them that housing prices, that you could get you get a mortgage with no documents, and, like you would apply for the loan and the next day you would be approved. And then, people were buying multiple houses with no income, right? Like they don't believe you, right? Because that's not a world that they experienced. But if you were in a world that experienced that, or you lived through the .com boom and bust, right, where it was everything was eyeballs, well, it kind of feels like AI, right? Everything's AI, but nobody knew how to monetize it, right? When you look at OpenAI, you look at Anthropic, right? They are subsidizing this entire economy. Based on what, right? And you've got this whole thing of, well, NVIDIA's investing in OpenAI, Microsoft is investing in them, and like they're kind of doing a little Enron game. And that's another thing, right? Do they even know Enron? Right?
I'm Enron.
So I think you need to, put yourself in their perspective, right? They don't know what they haven't experienced. And a lot of investors are in that perspective. They don't know what they haven't experienced. Not only that, but recency bias, right? We are human beings. Our survival instincts are based on what has happened recently to us, not what happened, 5 years ago, right? We need to know what is the danger today. And so even with us, right, we need to remind ourselves that just because the market has gone up and has gone up, for the last 10 years doesn't mean it will continue to go up. And so what we need to do as investors, we need to have a rational reason why we're going to this investment, right? So like with kids, and a lot of times the conversation centers around Bitcoin, right? And when you look at Bitcoin and you point to them, you say, okay, 10 years ago, if you got into Bitcoin, you would be a millionaire, right? Lots of your friends probably became millionaires investing in Bitcoin, but did you become a millionaire? No. Why? Because you didn't realize the opportunity until it was too late. If you get into Bitcoin now, do you think there's still a possibility of becoming a millionaire? And they're going to say yes. And you're going to say, okay, what would it take for that to be true? And what will make you realize that that is not true? What will tell you that your hypothesis is incorrect? And if they can't answer those questions, then okay, well, you might as well go to the casino, because with the casino, at least you know what your odds are. If you can't define your odds, then like, what are you doing here?
So in that regard, what's the one rule that'll keep someone from thinking they're or acting as if they're at a casino table and keeping their retirement portfolio on the investing side of the line?
Yeah, the one thing is that you got to know why you're going into this investment. Mm-hmm. You have an expectation of what the return is, and it needs to be based on rational facts. Right? It can't be based on, well, I think like if this investment, got a 20% return. Well, what's going to make you get a 20% return, right? What's going to be the external event that's going to cause this thing to increase in value? And if you can't articulate what that is, right, then you are gambling, right? Now, if you tell me, well, the stock market has historically returned 10% a year, okay, great, on the index. But if you're investing in, NVIDIA, if you're investing in any individual company, or you're investing in cryptocurrencies, well, you need to be able to answer that question. What is it that this company is going to do? What is it that this crypto is going to do that is going to make it double in value, or whatever that return is that you're looking for? And what is the thing that you're going to look for that's going to tell you that you're wrong about your hypothesis, right? How are you going to avoid losing all your money? Because that is always the risk when it comes to investing in individual stocks, when it comes to investing in things that are derivatives, right? Where they're not the actual investment, but there's something related to that investment. You need to understand what is the thing that can make this thing go to zero.
Makes sense. We got to leave it right there. We're out of time. But if you like more information about investing versus gambling, the WSJ or the Wall Street Journal warning, you can go to yieldsforyou.com for more information always. And I want to leave you with this. The tools being handed to ordinary people, the apps, the options, the prediction contracts are designed to feel like investing while functioning like gambling. But for you, a retiree, the stakes are different. You don't have 40 years to earn back from a mistake. If you can't explain why you own something with a time horizon and a reason, That's your signal. Investing builds a retirement. Gambling ends one. For Label Sternbach, I'm Freddie Bell, and this has been Label on Fire.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.